What's up, everybody? Jonathan Rose, owner, Masters in Trading. Major day. Today, we are going to get the buy signal. The buy signal, the buy signal, the buy signal. The VIX tool. Check out this back testing. Going back 10 years. It doesn't show off a lot of trade signals, but when it does, it needs to be respected. I'm going to go over the exact back testing. I'm going to go over the trade signal, and I'm going to go over 3 different trades you could take to take advantage of this unique but powerful opportunity. Let's go. So let's first start and talk about why we got a trade signal. The VIX tool looks at the VIX in 3 different time frames. So we have the VIX for 9 days. We have the VIX for 30 days. And this is what you're probably most familiar with. This is just the VIX. It's a 30-day VIX. And then we also have the VIX for 90 days. And the VIX for 90 days is going to be right here. Here's going to be your traditional, your normal VIX, the VIX that you're probably most comfortable with. And then we have the 9-day VIX. We use the VIX tool to look at something called VIX term structure. Why do we do that? Well, the VIX is an important measure of volatility, right? It's the expected move. But not only do we want to look at the risk in the next 30 days, we want to know the risk in 9 days, the immediate risk, the 1-month risk, the 3-month risk, the 12-month risk, and that's looking at the Vix Curve. Okay, so we got that out of the way. Remember, the red line is the short term, right? 9-day, 30-day, 90-day. Now, in a normal period, when things are good, when things are rosy, the 9-day VIX is going to be lower than the 30-day and lower than the 90-day. Because in normal times, we know that the next 9 days are probably going to look okay. The further we go out, the more uncertainty, the more risk. Well, how the VIX tool works is we wait for there to be a cross. We wait for there to be a major cross where that 9-day, the short term, is really getting higher than the longer term. And to summarize how the VIX tool works, whatever the time frame is that it gets over the 100 period moving average and stays inverted, we need to replicate that time frame once it gets back under. And today is the day. As long as we don't open down 500 Dow points and the VIX spikes, but right now it looks like the market's up 200 points before the opening. So what we're going to do is we are going to get one of these buy signals. Now, let me show you the backtesting report so I can support this argument. And then after that, we'll talk about 3 different trades that you could take. Don't take them all. 3 different ways to express the view that we possibly might see a very, very quick rise. Now, when these trade signals happen, we are looking for 100 S&P points, 100 SPX, 100 spiders. We're looking for a really, really big move. Let me show you the back testing report. S&P chart. If I hit the beaker, this is a proprietary tool that we built. VIX backtesting insanity. So we have the VIX. Let me scroll down. Now, backtest trade size. Let's look at S&P futures. We're going to do a 1 lot. We want to make 100 S&P futures points. If it doesn't happen in 21 days, let's get out. That's it. So you can think of this as a 21-day stop. We want to make 100 points, 21 days, we're out. Okay. Apply. Okay. Make sure we show the study. Always very important. Show the study. There you have it. It happens quick. Come, right-click, show report. Going back to 2013, this is the most amount of data that they would give me. If I scroll down, Total orders, 18 trades, $6,000. Max trade, total P&L, $59,000. But if we look at each different trade, all winners except one loser. We had one loser, but the rest were all winners. And again, when I say winners, that means within 21 days, we made 100 points or we got out. That's how reliable this strategy is. And this morning is the day that we are going to get a buy signal. Let me show you one more thing with the back testing. If I hit the beaker, we use a 21-day stop because we wanted to be conservative. But if I take out the stop, and say, let's not use anything. Let's just use this as, hey, if we get a signal, that's probably strong and we're going to want to be on the buying side of the market, on the bullish side of the market. Okay, apply, okay. Now we're going with no stop. Same thing, as soon as we get a buy signal, we want 100 S&P points. Right click, show the report. Again, what's changed? The only thing that changed is now we have 12 orders and now we have no losers. Most of us are comfortable trading with the stop. I get it. So for this trade idea, today is June 8th. This is going to be good for the next 21 trading days or we're going to get out. I, for one, think we're going to get a very, very sharp rally. For those of you who are out there thinking, well, geez, we just had a really sharp rally. Why didn't you get bullish way down here? I don't know what to tell you. I sure wish I did, but I didn't. But right now, we have a signal. I really try to take the human element out of this. I let the data drive the decisions. So, why did I miss this rally? I don't think like that. You're going to win, you're going to lose. What we're doing right now is we are getting our trade signal. This trade signal happens like on average once per year, but when it happens, I just showed you that data. It's very, very reliable. So here's how we're going to play it. For one, you could buy S&P futures. You could use a 21-day stop. That's okay. I don't like the risk of that because the risk is open-ended just using futures. I prefer to go to the options. So let's go to the options. Okay, so I have you at the spiders. You can see I've got some positions in the spiders. These are just really to hedge my portfolio. But now, things are going to be a little bit different because we got a buy signal. These, I'm long puts. But again, I'm going to ignore that position right now because that's been done. That was done for another reason, to hedge the portfolio. This is going to be a brand new trade. And now you might be thinking, well, why don't you just cover some of your long puts? I could, or I could just start fresh and think of a new trade. For me, I'm going to start fresh. I'm going to think of a new trade. Here's what I want to do. Remember, we're going for 100 S&P future points. If we look at the spiders, we're not looking for 100 points. We're looking for 10 points, right? That's the equivalent. It's not a $3,000 index. It's a $300 index. So we're looking for 10 points to the upside. 21 days, or we're going to be out. I'm going to go to July with 39 days, give a little bit more room. Actually, should we go right to 21 days? I don't know about that. How about we take you to the quarterlies, where we have 22 days? I think that would be a little better interest. We'll have a little bit more liquidity. Now remember, if we're looking for 10 points, that's how I'm going to start looking at the trade. And something to consider, 22 days, obviously this is a big move, right? Figure out what you're comfortable risking. Let's use the example of we decided that we're comfortable risking $1,000 on this trade. If we're right, we'll make some money, and if we're wrong, we're going to lose $1,000. You can make that decision to be $100, $10,000, $1 million, whatever table that you want to play at. It's all the same shit. We're going to look at a $1,000 trade. 319, something you could do is you could always just buy the at the money. Okay? If you buy the at the money, you can buy 2 of these. It'll be about $1,200. If you buy 2 of these, you are getting long think of it like you're long 200 shares from 319. If you buy 2 of these, you can never lose more than the $1,200 you invest. If you bought these for $6, again, just think of these like you're long 200 shares. If it gets to be 329, you'll make $2,000, right? Pretty cool. What you also can do is you could buy the 320s and sell the 330s. If you buy these, you know what, and I'm going to do easier math, for $5.50 and sell these for $1.50, which you can't do right now if you just look at the markets, but it's pretty freaking close. So give me the benefit of the doubt so I can just do the math real quickly in my head. That's going to be a $4 trade. If you do a 2-lot, it's $800 of risk, and you could make the difference, 320 minus 330, you can make $10 2 times. So you can make $2,000 on, you know, that $400 investment. So 3 different things you can do. Just buy S&P futures, hold them for 21 days, buy at the money options, hold for 21 days, or you could always do that vertical spread. That'll get you in for a little bit cheaper. Okay? Hope it helps. We're bullish. This has been right going back to 2013, pretty much over 90% of the time. Big deal for us. This is the VIX trading system. Hope it helps. My name is Jonathan Rose, and I'm the owner of Masters in Trading.